So in this session we'll be taking a look at commercial banks. So we'll first of all look at the balance sheet activities of commercial banks and also the off-balance sheet activities of commercial banks. So first of all, balance sheet activities. Balance sheet activities for commercial banks arise from the intermediated finance role that a commercial bank plays. So remember that intermediated finance involves the creation of two financial assets between the supplier of funds and the users of funds, and commercial bank acts as that intermediary, creating both the financial instruments. So basically the assets of a commercial bank are the loans or uses of funds. The liabilities are the deposits and one source of fund, and equity is the shareholders' equity, which is another sources of fund. So just going through some of the different types of sources of funds, we've got capital account deposits, which are simply a business operating account, so a high liquidity account but has low interest. There's also call accounts, which are just on-demand funds. There's term deposits, which are longer term accounts with high interest. And note that the sort of higher the liquidity or the shorter the loan, the lower the interest is going to be. So in the case of capital account deposits, where it's quite a high liquidity account because it's an operating sort of account, it's going to have very low interest. But term deposits, which is more an investment account and long-term account, it's going to have a much higher interest. There's also what we call negotiable certificates of deposit, which are simply short-term money market securities, which are basically discounted. There's no interest in negotiable certificates of deposit or CDs, so they're basically discounted to reflect the fact that there's no interest. They're just going to be discounted due to the time value of money. There's also debt liabilities, which are a long-term security which is issued in the capital market. These liabilities can either be secured, such as debentures, or unsecured, and they can either be fixed to a certain asset or floating. So a secured security is simply one that's secured against a particular asset, which is then a fixed, or a specific value of assets, in which case it's floating. Floating security will generally be preferred as it allows for a higher level of flexibility in asset management, because if it's fixed to a particular asset and that asset's sold, there's a lot more restriction in your debt liability. There's also some other types of sources of funds, and these include foreign currency liabilities, which are high value liabilities, so somewhere between 500 million and a billion, with 3 to 6 month duration in foreign currency. There's loan capital and shareholders equity. So these can include any hybrids or just normal, like ordinary shares. So in terms of some of the uses of funds, we've got personal and housing finance, so that's just mortgages, fixed term loans, any personal overdrafts, credit cards. There's commercial lending, so for businesses, so an overdraft for them, maybe some leasing or commercial bills. There's lending to the government, and there might be some other sort of types as well, anything to do with lending of finance. So in terms of off-balance sheet activities, there's there's 4 main types of off-balance sheet activities, and these are quite important. So first of all, there's direct credit substitutes, and these are basically undertakings of the bank to support the financial obligations of the client. So for example, there might be a letter of credit. So whereby the bank agrees to meet any sort of financial obligations of a client to a third party in the case of default. Or there might be a letters of comfort, which is where a bank basically guarantees that it will provide finance to a company. So this would be used in a case where a business is tendering for a particular job and they get a letter of comfort from the bank to ensure the company whereby the tender is being issued, that if they are accepted in the tender, that they will have finance to complete the project. There's also trade and performance related items. So this is an undertaking by a bank where you promise the payment under terms of a specified contract. So something where if a performance is not met by a client under a particular contract, the penalty will be paid by the bank. There's also what we call commitments, and commitments are basically contractual obligations of a bank that they haven't completed or delivered yet. So something where a credit card limit has been approved but no withdrawals or have been met as such. Or maybe a loan's been approved but not drawn down, or forward arrangements that haven't been completed yet. So this is commitments that the bank has approved or committed to as such, but nothing's really been done to make it a balance sheet item yet. And finally, there's market related contracts. These can be anything from foreign exchange contracts, interest rate contracts. They're basically derivative products. Remember that we looked at derivatives in the last session, and they allow for risk management of banks. So they allow management of exposure to different fluctuations of interest rates or foreign exchange rates or commodity prices. So you're going to use derivatives to sort of hedge your bets and lower the risk that you've been exposed to. That's about it for this session.